Welcome. How's everybody doing? Hope you are doing well. My name is Andrew Kuhn from Focus Compounding, sitting next to Geoff Gannon. Jeff, how's it going today?
It's going very well, Andrew. How's it going with you?
It's going great. We hope it's going great with everybody else as well. If this is the first time you're tuning in with us, thank you so much for joining us. Be sure to check out all of our content on the internet. If you're watching the screen right now, this is our YouTube. It is Focus Compounding. We have Focus Compounding, the website. We have my Twitter. We have YouTube. And then, of course, we have the podcast. So if you're into learning more about our content, we're basically everywhere on the internet as long as you type in Focus Compounding. So we've been recording podcasts for over 4 years now. We're having a lot of fun doing it. We're having a lot of fun doing it. So if you want to go through our backlog, I promise you there's a lot of listening and watching for you to do. If you're interested in learning more about our money management services, we are investors. We do run a hedge fund and a managed accounts arm. If you're interested in learning more about that, you could go to the Invest With Us tab at focuscompounding.com. So in today's podcast, we are going to... Have you ever seen the Markets in Turmoil segment on CNBC? No,
I have not.
I could answer that question. No, you have not. I've never actually seen it on CNBC because I don't watch CNBC, but I've seen the clips that CNBC or other people will tweet out. It's just a quick segment that says Markets in Turmoil. And people always kind of use it as a joke because as soon as they start playing that segment, then that means like, oh, we've bottomed and markets are, going to go up. But since markets have been selling off and they are currently selling off right now, I thought it'd be great to dedicate a podcast to snap judgments to see if we could actually pick out some interesting cheap stocks that people have been following. And the only caveat I added when I did a call for stocks is, what stocks do you want us to look at on the pod? Please share companies that look cheap based on valuation, and not just because it's down a bunch from its 52-week high. But before we jump into that, I could pull out my handy dandy PowerPoint right here. SP 500 down 17% year to date. I think I just checked in the car before I pulled up. We're down about another 2%. So we're very close to the bear market territory in the S&P 500. I believe the Nasdaq's already there. 10-year, 2.812%. Crude oil, $110 a barrel. And natural gas, $8.749. That hit a new high today. That's something that's a crazy move in natural gas. I think it's up like 150% year to date. I mean, these are not tiny moves in natural gas. And honestly, I don't think a lot of people are talking about it.
People are probably wondering why we're the only one that lists natural gas on the
it is a KPI I do follow, right?
It's up a lot more than oil. Because oil was what, 6 in the last year it was over 60 a year ago already, so it's not even up 100%.
Do you have any thoughts on, I feel like a lot of people when they look at like the oil markets, especially if you're just a value investor, they're just so volatile, right? Like you look at crude oil. I mean, a year and a half ago, we were recording a podcast where oil was negative $30 a barrel. So they were paying people to take away oil. And here we are today at $110 a barrel. I mean, just such crazy volatility. And then natural gas as well. Do you have any general thoughts on crude or natural gas? Or, I mean, again, it's like we're not commodity investors, but we do invest in companies that have exposure to the commodity markets.
So I don't really have a lot of thoughts. They're physical markets, so there's a speculative component to it. But unlike the other things we're seeing here with treasuries and with the S&P, look at inventories and things like that. It's the same thing when we talk about used cars or houses. Prices can move a lot because you can't suddenly put in a lot more supply, and if there's short-term increase in demand, or what happened with COVID, which is a drop in demand, the likes of which had never happened before. There's never been a sudden drop in oil demand like that.
I hate that whenever I hear the likes of which, I think of Donald Trump. The likes of which you've never seen before. But how do you handicap that as an investor? Are you just looking for the extreme points? And that's true, right? Because we look at all of this on a screen, but all of this supply takes time to work out. which is challenging. I mean, I was actually reading an article of what's going on in the Permian Basin, and this article was saying that they're just having a hard time meeting demand. I mean, it's hard to hire truckers. It's hard to hire people. So it's like the supply side just not really getting balanced out.
Yeah, the one thing I've mentioned before is I don't like the break-even price idea that, at this price is what we need to break even on this production at this place. Because what happens is at the bottom of the cycle, it's pretty cheap to be able to increase production. And at the top of the cycle, it's really expensive because everyone else wants all of the same services, same labor, all those things. I mean, the things we're seeing with a tight labor market and inflation are true for anyone who wants to increase production of oil. It's going to cost a lot more now than it did, 2 years ago.
Mm-hmm.
Try hiring people and, bringing on a lot more. Same with home building or any of those things. You can't suddenly start things up and shut them down like that. I mean, you could if you had slack in the labor market, but it just throughout the entire economy, things are tight.
So what do you do? I mean, like a company like NACO that has a minerals management part of the business. I mean, when oil and gas is this high, I mean, from a capital allocator perspective, I mean, does that make it tougher? I mean, to your point, I always like to bring everything back to real estate because I think most people generally kind of understand real estate because they either own a house or they see it, whatever, it's tangible. But sure, I think most people could understand it's probably tough to be a builder when prices have gone up 2 to 3 times since 2020. And I don't know if that's the exact number, but when I'm on Zillow and I'm looking at like the home values of a lot of these houses from 2020, I'm like, holy smokes, this value's gone up 2 to 3 times since 2020. That's pretty crazy.
Yeah, but in some places, the cost to reproduce is gone up by a large amount too. So, I mean, it's a lot different. This is true for any market that we're looking at. You're speculating when you're talking about a price that is significantly higher than the cost to bring on new supply in the same area, comparable. So if you're talking about a house and the cost per square foot to build a house is similar to the price you're looking at, that's very different than if the cost would be much lower, but you're saying, well, but their land is scarce and there's going to be these issues with getting permits and stuff. And so I'm willing to pay a lot for this, but it's a big premium over what it would really cost to reproduce it. But if you're talking about something like when we talk about car dealers and stuff, some of them trade at prices that aren't very different from what it would cost to have, to add new supply. And so if that's the case, when you're talking about price to tangible book and things like that, that give you a hint about that, then you're not really speculating a lot, even though it may go up a lot over time. The cost to with inflation, the cost to build certain things goes up a lot.
How do car dealers manage that then when they're buying inventory themselves? Could they be caught holding the bag?
Yeah.
It seems very challenging.
Well, Carvana was caught that way, but so is Walmart and Target and companies like that. It's hard for all of them. Some of it is, we talk about the trade-offs between reliability and efficiency. And a lot of times companies focus on efficiency in the current period, what they think is going to give them the best outcome. But that can be risky. And that's and some of them probably use a lot of computer stuff to figure this out. And they don't have experience in different environments, or they've forgotten those environments. So things like Target and Walmart, but also Home Depot and Best Buy, but they've done better, but they have the same issues potentially in car dealers. How much inventory should you carry? Should you really respond as much as they did to a big increase in demand? They probably shouldn't have. I was actually at a Walmart before they came out with their earnings and was horrified by the inventory situation. I'd never seen anything like it. It was just spilling out. I mean,
so take us through that.
It was, I was like baffled by what was going on, and it didn't look like they could take any more inventory than they already had. They had things stocked really badly where stuff was like, they had filled up an entire area that customers could actually reach. And so they had different flavors and different, slightly different brand things with the SKUs that are a little less popular that are just stacked up higher because they couldn't even get all of the product out there to have, facings for everything. So many new employees. It looked like they were having conferences in the halls, basically, because there were so many people who obviously were new, didn't know what they were doing, and were watching other people do stuff to learn how to do it. And so I'm there and it's closing. And so I see all this and I'm horrified by it. And then they've got like 5 giant trucks they're pulling in to like bring more stuff out.
Oh boy.
Yeah. So, but that's one Walmart and everything. But I'd never seen it like that. And of course, there was a point in COVID where I saw, I don't remember being a Walmart, but I saw some Target and stuff that were completely understocked with things to the point that they're being wiped out, in the first few weeks of people hoarding stuff. It was bad. So, they have to deal with each of those problems. So they made a mistake.
And I mean, news came out that Amazon they have like a hiring freeze, and I think they're going to lay off people.
They have too much warehouse space.
And yeah, they're trying to get out of their warehouse space. And we've talked about that. That's the biggest fear we have when looking at these companies, is just projecting certain things that's going on today into the future. That's what makes all of this so freaking hard.
And I think they're more responsive than ever, these companies, Amazon, Walmart, ones like that, to trends that they see, and they leaned into those trends too much instead of using some common sense about what was happening with COVID. And always they're afraid of losing sales, so they'd rather have problems with too much inventory than to lose market share. But it was obviously it's going to be a problem for them.
Yeah, Target, they reported this past week, and I did have it up on the screen, but they basically said that demand from customer shopping and stuff like that is kind of waning. A lot of people gave Shaquille O'Neal crap or flack because he said that with gas prices high, the typical person's gonna not spend as much on these other things like a Target and Walmart and stuff like that. People thought it was a joke when he was talking about it, like his logic by the whole thing. But I mean, it's actually true, right? When gas prices, I saw in California a picture, $7, over $7 per gallon. And where we live, which probably will have the cheaper price per gallon, is like, high fours. I don't think we've crossed the $5 a barrel yet, or per gallon. But it's just crazy. I mean, if the Fed wanted stuff to slow down, the market to slow down, I definitely feel like that's going on right now in the market. The amount of wealth that's come out of the stock market, the amount of wealth that's come out of crypto, the excess, and all those sorts of things, we're seeing it play out day by day in the market. So it's been kind of interesting to see. Do you have any thoughts on like Target or Walmart or anything like that? Or was that just sort of a soft sign that you saw from just being a normal customer?
Well, reading their statements that they put out around earnings. So these are quotes from earnings call transcripts and things like that. It'll be interesting. If things slow down significantly and inflation gets under control, then they'll be okay. But they're not shifting as much as you might think in terms of their approach. If you think about the actual real volumes that they're doing, they were really weak, and they probably needed higher prices and less increases in certain expenses than what they had. I think they've grown for a long time by trying to keep prices really low compared to their competition, and we'll see how that goes. But but certain business models like Walmart and Target could run into some real problems if they don't, and some dollar stores and stuff like that, if they don't kind of adjust to what's happening now. Because people who are at these companies have had entire careers where they didn't have experience with what it was like in the early days of Walmart, where inflation was a lot different. So, and especially because these companies source a lot of stuff from China, where there's more deflation in the products coming in than there is in other parts of the economy. Historically, there hasn't been as much inflation in what's sold at Walmart and Target as there is in the economy overall, like services stuff, sticky inflation that I talk about all the time. That stuff always ran higher. So it's kind of part of their strategy to keep a very tight focus on not increasing prices.
And would you like to see them increase prices if you were an investor looking at Walmart?
Clearly, increasing prices would have helped, because I think they may not have understood the elasticity of demand in the face of price increases. It's likely that if they had increased prices, they wouldn't have hurt demand as much as they thought they would have. That keeping prices low in real terms didn't drive actual increased demand by much at all.
Can you explain that? Evidence. Like what that means for people that aren't familiar?
So far with a lot of these companies that have reported, I'm seeing very little evidence that people are responsive to price changes. So increasing or decreasing the price on an item by 5% probably is not driving significant changes in the amount of sales that you're getting. So for instance, cutting something by 5% doesn't seem to be driving much in the way of increasing your sales, but also raising prices might not hurt you that way. It's important to know that number more than anything else. That's really the number that you should be focusing on with any business in terms of your pricing. Many businesses don't focus on that and have other ways of thinking about pricing, but that's ultimately what you want to worry about. So for instance, as an example, let's say you have a chain of gas stations and you really make your money on the convenience store aspect of it, right? Mm-hmm. So people think that higher gas prices are good for you, but they're actually bad for you because the total volume that you'll sell will be lower because gas prices are up. When that happens, you actually get lower traffic through your stores. And if gas prices are up and nothing else is up, when that happens, it actually is bad for the location. And that's because of the elasticity of demand. There is some responsiveness. It's not very big with gas, but there's some, which means that people consume a little less gas when the price is higher. And if you're not making a profit on that, then it causes you a problem. And some places have gas as one of the ways to draw people in.
Mm-hmm. So you would like to see, I mean, we spoke about through COVID, there was a few companies where they were just experiencing so much demand. And you always said to me, they should just raise their prices if demand is killing them right now.
Disney understood this with their hotels and stuff. Yeah, they raised prices. Mm-hmm. And I think they were right to do it because they didn't want to cause demand to drop so much at their domestic parks.
So then what do you do when demand starts to slow down? Do you reduce your prices?
No.
You just keep it right there.
Well, you might reduce them, but what you need to do is think about how the responsiveness is. Hotels ran into this in the early days of COVID. Their models would tell them to cut prices. But there's a point where they realized, airlines too, but hotels realized that cutting your prices beyond a certain point is doing absolutely nothing because the reason people aren't going is because they're not traveling. They're not going to be there anyway. They're worried about COVID in that area, whatever. It is not because you can entice them with having a room rate that's $50 instead of $150. In normal times, you can adjust that so that you know how much occupancy you can drive, but that may not be the case in some other situations. And I think what Walmart and Target probably didn't realize is that their lack of real demand has to do with people being exhausted in terms of real units purchased. So it's not that you're not buying a big screen TV or recliner or whatever because the price is wrong on it. It may be because you bought it last year. And that's very important to understand things like used cars. For cars generally, there hasn't been, we talk about like bubbles and things and stuff like that. There hasn't been much of that. So there's been a huge increase in prices, but it won't really change much the trajectory of people's car purchases in the future as much as you might think, because it's not like you built a lot of cars and actually took up more supply that will have an effect in future years. You didn't at all in a lot of countries. So like the US, UK, places like that, it really hasn't shifted expectations in my mind for what car sales will be 3 or 5 years out. Whereas like in the housing bubble, you actually built a lot of houses. So that changes things a lot. That's a very hard overhang to deal with if you literally have too many houses in some places. But we're not running into that with too many cars in some places, really. So it's important to keep in mind that sort of thing, that an oversupply, which is a very bad situation, is different than just a price going up a lot and then coming down. That can have some big short-term effects. We talked about that a little bit with housing, with increased mortgage rates and things like that. But the bigger issue is like if you see an increase in the actual supply of homes newly built in some areas, that's a thing that takes longer to work through,
And the opposite of that, having low inventory, is going to take a long time to work through as well.
We talked about reading the Daily Shot, that email.
Yep.
Yeah. So you can look at
what happy you like reading that. I knew you would like it. I knew it, Geoff. I knew it. People could go to the dailyshot.com. It's like $15 and you get a daily shot, a daily email of just economic data that's going on throughout the world.
So they're great graphs, especially not because of what the graphs are, but how they choose to show them to you. So for instance, one of the things that they do a lot is like the last 5, 6, or 7 years or whatever, giving you throughout the year the levels of this series that they're tracking was at. So like inventories, you can see, okay, what are gasoline inventories now versus what they are at this time of year in 2017 and 2015 and, compared to this year, and not just a 1 year thing or something like that. And when you have things where you're below the level of the inventory that you normally have at this time of this, month, for each of the last 5, 6, 7 years, then that's a tight situation, right? Now, some things can change. Like, for instance, in gasoline, there is some changes to conservation and things like that. So if you have a much higher price but the same inventory level, that means you might get through in the future better than you had before, because you're actually getting demand destruction, right? By having so much higher prices. And of course, for some of the other things we talked about, natural gas and stuff like that, you also have, we can't predict what the future weather will be. So an inventory level might be appropriate if you're about to have an unusually seasonable period. Whereas it's not good if you have a low inventory level and then you have an unusually hot period or cold period of whatever it is that you would have a lot of demand for heating, right? Mm-hmm. So there's always those factors. But I think Walmart and Target are good examples of places that we know that a lot was sold. The extreme example is like a Peloton or something, right? We talk about that. But a lot of stuff sold at Walmart and Target, and they should know this about what they're selling and what they're not selling, is stuff that people don't need to repeat purchase in future periods and can put off. They're more durable items. And they also have shifts with how people spend when they're at home versus how they spend when they're out. So it could be a shift that means you're selling less furniture and you're selling more makeup and clothing and things like that, right? And they should be able to see all those patterns, but have an idea of that. And you want to slow down the rate at which you're buying certain things based on that idea. But they're reluctant usually to predict future declines in demand from what they are now, because if they do that, then they're not buying a particularly hot selling item, what it looks like now. But that can be how you end up with too much inventory.
I wanted to hit pretty quickly just on Twitter, since we talked about Twitter and Spirit as a potential arbitrage. Musk had tweeted back to somebody. Somebody said if 25% of the users are bots, then the Twitter acquisition deal should cost 25% less. He says absolutely. So that's the way that he's communicating, is through Twitter. Somebody else says, yeah, has Twitter gotten back to you on how many real active users they have, or same as before? And he says, no, they still refuse to explain how they calculate that 5% of daily users are fake/spam. Very suspicious. So Twitter said that they are moving ahead with the deal. Elon has shown, I guess, no sort of motivation for that to happen. They do have a signed agreement. I think this is going to be interesting to watch from the sidelines. Have you ever seen a situation like this where they have a signed agreement and one of the parties wants to back out? I mean, Snapchat reported earnings yesterday.
Right. Twitter would probably be down by more than 25% if it wasn't for the deal. Because businesses, as you're pulling this up, Snapchat's down 40%.
Yeah.
And presumably it's one of the closest comparables to Twitter.
And so is Facebook. So Snapchat, I believe, is worth like $40 billion right now. So people are saying like, there's just no way that Twitter is worth whatever the price was, $45 billion or whatever. But yeah, so Facebook's getting hit as well based on the news of that Snapchat. And then, here's Twitter, and it's at $36.19. The deal was for $44 billion. Have you ever seen a situation like this before, where
what's
the buyer does not want to actually like move forward with something that they signed off on? $28.9 billion.
Okay.
So is it like $50?
Yeah. I mostly because of financial conditions, but this is a different example. But yeah, mostly financial conditions, difficulty in that it no longer makes sense financially to put the deal together.
So what does he do? He just pays $1 billion and leaves?
I guess. We'll see what happens. But same thing I said at the last time we did the podcast. The issue is, what bargaining power does Twitter have in this situation? And that's probably why the spread is so big, is in large part that if the deal doesn't happen, the expected loss that you think you're going to get in this arbitrage situation is very large. So it's not so much even necessarily if the probability of the deal going through is going down all that much. It's that the comparables that you're trying to use as for how far the stock would drop might be a lot bigger, right? Because if this deal drags on for a long time, say Activision, Microsoft drags on a really long time, and then all other stocks in that group get re-rated, then you can have very big declines, right? Because there's lots of tech companies for which you'd assume that you might drop 30% more than you had expected before if the deal doesn't go through. So that's not totally illogical that you could have such big spreads, because it's the magnitude of the loss Not so much the probability that the deal won't go through. Although here there's obviously real doubt about the deal going through too, because he may not want to do it if he's paying a really inflated price for it.
Okay, let's jump into it. Could pull up quick FS. Markets, like I said, are off about 20% year to date. So the only caveat I asked for people was to only give companies that I guess you could reasonably underwrite as being undervalued. We'll see if that holds true.
It does for the first one.
It does for the first one. And we've talked a little bit about Citigroup. We've talked about financials. I think financials are pretty cheap. Warren Buffett, or presumably somebody at Berkshire is buying Citigroup. Any thoughts on Citigroup?
A lot more. I wouldn't be surprised.
Yeah, for bigger. Price to earnings, 5.6 times. Price to book, 0.5 times. Return on equity, 10-year median returns of 6.8%. It's a $102 billion company.
Yeah. So here we have it. We don't have the tangible book and stuff, but here we have it like half of book value or something like that, according to QuickFS. I think JP Morgan's long-term target is it wants to earn a 17% return on tangible equity. Someone would know that what exactly their target is, but it's something like that. And so obviously when you have peers that think that they can earn, high teens percentages or even just double-digit percentages, then a stock like this would be attractive. We could go to Bank of America, because you might get a feel for, so their Citi, what Bank of America looked like when Buffett was buying into it. So it looked a lot more like Citi. It doesn't show the price here and stuff, but it would be similar in terms of book value then to what Citi is now. So things improved a lot there with Buffett, or they improved somewhat there. And it wasn't necessary for them to improve much more than they did. For that stock to work out well. So you have a sort of similar situation. I don't know if I wouldn't say that Citi's franchise in the U.S. is anywhere near as good as Bank of America's, but it's so much cheaper than peers.
Do you like JP Morgan?
I do like JP Morgan if you're going to buy a very large bank. I think the prices that you're getting on very large banks aren't necessarily as good as somewhat smaller banks. Because I think they're the highest quality, somewhat smaller banks are actually capable of earning higher returns than the very largest banks in the U.S. I would be surprised if the very largest banks in the U.S. are capable of earning returns as good as some of the best regional and smaller banks.
Do you think we're back at like 2020 low valuation numbers for some banks?
Yeah, these are low valuations. Yeah.
This is feeling like deja vu. Back to 2020 when we talked about Bank of America. You're right. If memory serves right, I believe it was like basically what Citigroup was trading at, like on a price to book basis.
Yeah.
I remember it being very cheap.
And I think that we also have an unusual situation in that it's very rare, what we've seen so far this year, to have large increases in treasury yields at the same time that you have decreases in bank stock values. That very, very rarely happens. They usually move more together. So that is, I should say, inverse. So as people are selling down treasuries and their yields are going up, people would be buying bank stocks and vice versa. And the reason for that is that generally they believe that higher yields are a benefit to banks.
Mm-hmm. Yeah, usually you see financials participate. Right. Like when energy takes off, when the market starts to get volatile or all these different things that's presently going on. And financials just haven't really participated at all.
And one possible reason for that is that you're having increases in yields at the same time that you're having expectations for slower growth.
Recession, sure.
Right, yeah. Recession. So that's somewhat unusual because normally you have increasing yields at a point in which growth is seen as being too strong. And so the two kind of go together that way. You don't usually see this. It has happened before. Probably maybe 3 times or something from the 70s through the 80s. There were several recessions at which yields were rising into each one and progressively higher yields on each recession. Yeah.
So Citigroup, though, you like it as a snap judgment?
I think that it's cheap. I don't know if I would do a basket or what. It's a huge company. If you need to put billions of dollars into bank stocks, it seems very logical that Berkshire would do this. It does seem a lot cheaper, obviously, than JP Morgan and Bank of America. I haven't looked at Wells Fargo recently, but those sorts of banks.
What would the thought process be to underwrite it at like a price to book of at least 1 or close to it.
Right. If they could earn double-digit returns on equity in the future, which would be, I'm sure, their hope that they can get to that. And with higher
interest rates,
that seems very possible. I mean, you can see what the net interest margin is. You should be capable of earning decent returns with that. I mean, when we do like pre-tax, pre-provision earning stuff, it should be pretty high because you can see over the last 10 years, their net interest margin averaged 3.5%, I think it says there. And yet their return on equity was, what was the average return on equity?
6.8%.
That's very bad. So usually your return on equity, we could pick some other bank, but usually your return on equity, your net interest margin times 2 is not going to be your return on equity like what we're seeing here. So if you pick, pick Frost, for instance, net interest margin is 2.8%, so it's lower than Citi, but return on equity is 10%. This is their average over the last 10 years. So you can see that's over 3 times. So that's a significant difference. And I'd say that's usually going to be the case.
That's pretty normal.
That you're going to have much better return on that than, So, and we can see different reasons why that's happening with Citi. One is large provisions for losses throughout the period. And Citi had a really bad experience with the financial crisis. And some of that may have lingered for a very long time in the period that we're looking at. Citi also has a lot of stuff that's not in the U.S. And it also is involved in some businesses that aren't purely net interest margin driven stuff. But so is JP Morgan, for instance.
But you like Citigroup.
I like the price, yeah.
Yeah, you like the price. You like smaller banks, but if you had to buy a large bank, you would like the price.
Or even just a large stock. I don't know what other $100 billion, isn't that market cap $100 billion? I don't know what's $100 billion side that's that cheap. What else is there? It's $100 billion and that cheap. I can't think of it.
Into a rising rate environment. Next company, QDEL, Healthcare Equipment and Supplies Company. Applications for infectious diseases, cardiology, thyroid, women's and general health, eye care. So, I really have no idea where to even start with this company.
Company markets, direct sales, use in physicians' offices, hospitals. Okay, reference laboratories, universities. Okay. It's a lot of different products it seems to be describing there. Yeah. There's some tests we can see there. Yeah. So a bunch of it is testing. We don't know how much of that. Some of it is pretty basic stuff.
And in 2020, they had a 210% growth in revenue. And then
is this
COVID related or did they acquire something
related? Well, some of the specimens, so what they're talking about here, it could be something related to that.
Yeah, infectious diseases.
Human viruses, including respiratory and other things, herpes they mentioned, for instance. But, so let's look at what
look at their operating profit in 2020. $1 billion.
So that is a bit of a problem. So we're at 40 times pre-tax profits before COVID.
Yes.
So I can't really evaluate this stock. I mean, you're looking cheap based on results since COVID, but this company has no history of particularly strong EBIT that I can see going back to the early 2000s. So it's all based on 2020 on. Although it was not a small business in 2019. I mean, a $500 million revenue, it just wasn't. And it wasn't bad in terms of the operating profit, right? So your margin was almost 20%. It had been 20% in 2018 too.
That's what the market cap was in 2018.
It was definitely a decent business back then, but it's probably a lot cheaper.
I would have put a $1 billion valuation-ish on it. It was 1.4 billion.
Yeah. So can't tell because something happened, in the last 2 years that's changed things a lot. If it goes completely back to what it was before, it's too expensive, right? But if it goes halfway back, it might, not quite halfway back, let's say, or it takes a little while to get halfway back to what it was, then it might be appropriately priced. But, also the enterprise value it's telling us is only $3 billion. So, halfway back, it would not be too expensive, probably. So if you can keep at least half of whatever they've gained here, then it might be a cheap stock, but you have to probably keep at least half of the bump of whatever that is of the last 2 years.
Let's see. Love. Sales growth, good gross margins, a balance sheet, no long-term debt. Ticker Love. The Lovesack company.
Oh,
big bean bags.
Are you familiar? Yeah.
Yeah. I had one called Monster Sack.
Is it like a knockoff?
A knockoff version.
Yeah.
I don't remember. I mean, I asked her for my birthday when I was like 13. I thought it was so cool that I remember when I got it, I just slept on it for like 3 days.
Now, is this one that sells through malls as part of what it does? Okay.
Yeah. Mm-hmm. The Lovesack company designs, manufactures, and sells furniture. Actually, the one in Frisco has a Lovesack retail operation. Stonebriar.
Yeah.
Mm-hmm. As of January 30th, 2022, the company operated 146 showrooms and markets its products primarily through Lovesack.com. Mm-hmm. As well as showrooms at top-tier malls, lifestyle centers, kiosks. Okay.
So let's start with, did COVID drive higher sales of this product? No, it was growing pretty fast before then. Mm-hmm. And on bigger numbers, was growing about the same rate for COVID. Yeah. Mm-hmm. It was not profitable, however, before COVID.
It was not, no.
In fact, it wasn't.
Is this one of those companies that was trying to reach scale? What's going on here? We got price earnings 10 times, EBIT free cash flow 20 times, gross profit, the 10-year median margin of 54.6%, which it's kind of
it should be
hung around there.
Like a mattress company, that same sort of thing. It shouldn't be an expensive product to sell on a gross basis, but your operating margins are often poor until you get enough scale. That's the hard thing. Let's see. EV to sales 0.7 times. I mean, you basically have to keep the margins you have now. Mm-hmm. So it's cheap if you keep the margins you have now and grow sales at all. It's reasonable to cheap, depending on how fast you grow. But if your margins are not as good as they have been just for the last year, then you're, a lot of stock issuance. Mm-hmm. All right. Let's see what the share counts look like. Can you do that in,
Yep.
You gone from 13 million shares to 16 million?
Yep.
Oh, you were down at 11 in 2019. Mm-hmm. So actually you went up. That's interesting. Yeah, let's look at cash flow statement.
Could this fall under like the home improvement trend through COVID?
It could.
But it was showing decent revenue growth.
It was showing good growth before then, and it's not a particularly large company.
I feel like this company's been around for a good... This brand itself has been around
and it says it's been around since the 90s, but it was selling
yeah.
very little just, in 2016 that we can see. So negative cash flow from operations each year through 2020.
Yep.
Yeah, I mean, you really had to have hit some sort of inflection point. That's some big deal now. And the major increase, by the way, that happened in 2022 and trailing 12 months is that they worked through probably inventory. We don't know, this doesn't tell us, but they had a major, 2021, that they had the change in inventory. And then they would have done even better this past year. In fact, on an income basis, they probably did do better. But let's see.
He said no long-term debt, but they will have leases.
That's true, yeah.
Right? Something's booked under
that's
capital leases. Yeah, 97 million.
But not a problem at all, given the current assets. I mean, so just so everyone knows, like the current assets here says is 225, total liabilities 215. If current assets cover total liabilities, you're in a very good position, especially if you, if you have, some sort of free cash flow, at least positive cash flow from operations. So certainly for the last few years, this doesn't look like it presents any credit problems. The reason why you see high PP&E in 2022 is presumably a change in accounting for the capital leases, because that's why you see the capital leases appear down there. So the balance sheet didn't really grow that much. It's just a change in how they accounted for it this last year.
It's microcap, 457 million.
Yeah, what's the share turnover? I bet it's not low.
Yep, 739%.
What's the beta?
2.43%.
So not for the weak of, for those with weak stomachs.
Yeah, this sucker probably moves around a lot. Let's
see. But look, if it's not a thing that I'm good at, judging what the next trends are going to be and whether this trend is going to continue and stuff like that. And it came public, I guess, at not a low price, because it's come down. It's grown a lot. It's at a low price today, right? What is it? 10 times earnings? What is this?
Yeah, yep, 10 times trailing.
10 times trailing earnings. Okay, but you're not that far different from your, not that far above your initial price that you went public at. It seems, if that's right, the chart.
So how would you be looking at this? Would you be doing like a 3-year average on? Well, I guess operating profit.
I'd be comparing it to other companies like this, and then trying to figure out.
I don't even know like a good comp. to this company.
It's not a bad. There's good and bad aspects to this. I am worried that it seems a little potentially. One, is the brand really strong enough? Because it is easy to have knockoffs of these things, obviously.
Yeah.
But two, there are large economies of scale. And I think people underestimate how good a business. Well,
they're not damn
furniture
cheap.
is not a bad business. No, in fact,
look at this, $1,000 for
right. But
and then they also sell other furniture as well.
Okay, but type in Lovesack cheaper or something like that. Cheaper Lovesack.
Let's see. Yeah, that's what I would do. I mean,
That's
like,
what
what's the brand with
Lovesack
this thing? You know?
So what did Google suggest?
Yeah.
Lovesack cheaper alternative.
Yeah. Look at it. They have one that's for $54, $55 on Amazon. I mean, sure, It may not be as comfortable, but I mean, come on,
that's why you have the showrooms to see how comfortable it is. Because an issue with this is like
the ultimate sack.
Like I bought glasses one time from a company that sells glasses online and in some
Warby
stores.
Parker?
We won't say the name of it because I'm going to say something negative about it. It was a lot cheaper than glasses I've got in the past. It was not a good use of money.
Really? Because I've always given my father credit because he's been talking about Warby Parker for like 10 plus years of how much of a scam it is to buy glasses at the eyeglass store and stuff like that. And he would always use Warby Parker. And then obviously they went public and stuff like that. But I always give him credit because I swear he's been talking about Warby Parker forever.
Yeah. So it depends on what works for you, whether it's, any of these products, how much you want to spend on it.
That's so sad that Warby Parker killed your glasses experience because now you never wear glasses.
I never wear glasses. Well, the glasses that I wore were quite expensive glasses. But I wore, what are they called? Oh, they're the ones that are it's a different kind of frame that they use. They don't sell through the major chains and things. I can't remember the name of it now, but it's a totally different frame thing, which makes the frames very expensive. But it feels like you're not wearing glasses. That's why I wear those. But the Warby Parker ones, no, they weren't so good. The ones that I got there, but so then didn't use them, and of course it's a waste of money that way. The issue here is that some of these are not bad categories for furniture. These are good categories for furniture, but you do worry with this the same that I worried when someone was talking to me about like Under Armour and companies like that, right? They had a product that was very successful in certain categories that can be copied a lot by others and maybe easier to sell. So you have to transition it into some sort of brand that's successful. So like Under Armour can't just say, okay, we have this apparel thing where our technology, our product is better. And then you can coast on that because other retailers can basically reproduce a lot of what you're doing a few years later. It's the same problem that a Hunter Douglas has or that razor companies have or whatever. A few years down the road, you can have something that's as good as what the other company was offering a few years ago, but you could have it at either a lower price or a lot of times it's not a lower price even. That's the most important thing. It's just much wider distribution, right? So you can widen out the market so much if you can have a Lovesack impersonator, a substitute at Walmart. And at Nebraska Furniture Mart and at whatever that people might go to. So it could be a little more. I'm not sure if you can build a brand as well here as you would in mattresses, that as durable a brand, but a lot of the economics should be similar.
Why do you think that is? Like, why do you think you could?
I think it's hard to pay too much for a good mattress. I think it's very you're not going to buy a bed and not use it.
Yeah.
You could buy
easy to rationalize too. You're like, you sleep, whatever it is, half your life.
So people spend too little on mattresses.
You would think that they would spend.
It's just too much of an upfront
yeah.
thing. And that's why financing is such an important part of it, because once you do the financing and you say, oh, you're going to pay it off over 5 years and I'm going to spread it out for you. And I'm going to,
I got a ghost bed. I got a ghost bed and it was, I think 0% over 12 months. Mm-hmm. It's like, yeah, of course. Why wouldn't I do that?
Yeah. So they have to drive all of the sales that way because people are so reluctant to make the big upfront purchase. I don't know if it's a great product or not. I would just be worried a little bit more that it could be, I guess what I would worry about is that it could become that people buy a product like it that's not from the company and think of it as being similar to the company. That was kind of my point about Under Armour. If they develop the brand so that it's like a brand like Nike, right? Then you can have a lot of success on the basis of the brand. But a lot of times I think they just mean certain athletic wear that is in the style of Under Armour, and that they lost a lot of sales to that at different places, that it had a lot of the same features. And I think, that's obviously possible here.
Yeah, look at the knockoffs. I mean, $289.
But we haven't tried these out, and we don't know if the knockoffs are terrible. There are categories where,
of course,
where the knockoffs are just a waste of money compared to the real thing. But I do think that there's probably some people who buy these things and then don't actually end up getting a lot of use out of them.
Yeah, sure.
Just because it doesn't fit into their lifestyle and however they're doing it, which is not going to happen with a mattress. It's not going to happen with eyeglasses for most people. You may end up having to go and buy another one not long from now because you end up not liking it, but you kind of can justify it.
Coinbase. Have you looked at this company at all? For crypto?
Not really, no.
I think it's. Let's see.
I'm
right here.
more familiar with the stock than the company, probably.
Yeah, a lot of people talk about it because it's trading on a TTM basis very low.
But I think
it's going to be different in the future, though.
Yeah, because if I remember
they're raising capital.
Yeah, what I remember that concerned me about this company, and this is, I really don't know this company well. There was some absolutely stunning number of people that they had hired during the year that were like just in the last year or something. Like the number of employees at this company was very surprising to me. Can you find the number of employees, do you think, somewhere?
Yeah, let's see if it's on.
If it hasn't updated. Yeah, it's not going to tell us there, I don't think.
No.
Well, look at that share turnover.
Yeah, that's crazy.
Yeah, so it's turning over its shares 10
the
10 times a year.
The CEO, he recently bought like $100 million house in California.
Oh, really?
Yeah. $100 million.
Well, if you got some stock in the company, right? And if you're able to sell some stock, which I don't know, that's how he funded it. But
so we can look at their
because this was once a very large market cap stock, right?
Oh yeah. I mean, let's see what it's at right now. It is $17 billion, and it came public at $300 a share ish.
Okay, so it was
and we're at $66.
6 times this. Yeah, it was more than 6 times this. Yeah.
Let's see. Number of employees.
I was surprised by how many employees they seem to have added within just the last year or so. I
mean, it's hard too when crypto is not completely, but it's definitely.
Yeah. So hiring. Oh, here we go. This is what I was talking about. Expansion. Okay. So
I'll read it. During the first quarter of 2022, we made good progress on our product development, highlighted by the beta launch of Coinbase NFT in April 2022, growing adoption of Coinbase Wallet, expansion of our staking offering through the addition of Cardano, and hiring over 1,200 full-time employees who help us build the future of crypto. So they hired 1,200 additional people in the first quarter of 2022.
Right.
That's one quarter. Holy smokes.
That's what I meant. So it is an incredibly profitable company, or it was. If there's like quarterly numbers, they made an incredible amount in one quarter for a company this early in its history. But I was alarmed by the increase in expenses, like in terms of just hiring a lot of employees. We were talking about, does Amazon have too many employees or too much warehouse space or whatever? This says we have significantly expanded our operations in recent years, both in terms of employee headcount as well as the number of customers. For example, we have grown from 1,249 employees as of December 31st, 2020 to 3,730 employees. Right. So
as of December 31st, 2021, and then they just expanded again.
Expanding again.
Yeah.
So even if we just use the 1 year number, that means that almost 2 out of every 3 employees are new within the last year, right? And it's more than that because we know they hired even more after that point. So a huge percentage, it was kind of like what I was saying about the Walmart thing. Like it just seemed at that Walmart that every employee was new. And that's because there's lots of churn and all the quitting and all that kind of stuff, I'm sure. But this is an extreme example of that. This is what it looks like at some startup. But the scale of it is huge. I mean, when you're in the early stages of some startup, okay, we had, you go from having 5 employees to 15 or something. Mm-hmm. But this is going from having 1,300 to over 4,000. Now that we know the latest numbers is closer to 5,000. That just seems like the possibility is there for contraction in the margin and all that kind of stuff. For even, and we know also there's been some negative changes on the other side of the business. But even putting that aside,
like in the crypto market,
yeah. But even putting that aside, this didn't sound to me like a company that was ready for a big decline in their market, right? Ready to survive it and to come out on the other side. Just because they didn't seem, I mean, it's a very high fixed cost sort of business, or I should say it's a very additional revenue is very profitable in this kind of business, just like at OTC markets or any of those things. But you have to be careful not to grow your expenses too fast, because if you grow, it becomes like a .com company where they grew their expenses too fast and their revenue would double, but they'd report an even bigger loss because they were anticipating already that, and they were anticipating that they keep having things going well in the stock stuff. The other thing is, like, with all these employees, did some people think they were getting stock?
Let's say, how's the morale at the company when stuff like that happens? I mean, for people watching, right? December 2021 revenue was 2.5 billion, and they had operating profit of 922 million. And then when operating leverage works the other way as well. In March, they posted 1.1 billion of revenue and an operating profit loss of 554 million.
Another way to
they also diluted a ton. They're raising equity, all these different things.
Another way to look at this is that in under a year and a half, revenue at one point went up. It went about 13 times. See, it was about 186 million. Does it say in June 2020 quarter?
Where are we at? June
2020.
Yeah, 186 million.
But then December 2021, this is a quarterly number, it was at 2.5 billion.
Yeah.
So, that's a big increase. It's probably a bigger increase than the increase in the number of employees and all that. And you can see it drops down beautifully to gross profit as there's little contraction in the gross margin. It was still 80% or something then. But I obviously can't make any judgment on a company that can increase 10 times or more in revenue in a period of like a year or two. It's just, how do you even manage a company that's growing that fast? And, all your employees are new all the time and all of that. And how do you have any idea of what your expenses are going to be and how bad your cash burn is going to be? We could look at a cash flow statement to get some idea, but I think we're going to see very different quarterly, cash generation. So, you went from, let's just take the last 3 quarters, for instance. You generate 300 million in cash flow from operations, most of which was actually taken up by stock comp, but that's fine. So putting that aside, as if you could just issue stock, you generated 300 million. That then increases to almost 3 billion.
Quarter over quarter.
Right, quarter over quarter.
We're not talking year over year or whatever. No. Quarter over quarter.
Quarter over quarter.
Good Lord.
And then, a move in a quarter that is bigger than what 95% of companies experience in a decade. Right, that's what we're talking about. And then a move in the opposite direction, which also fits that, which is then we go for cash flow from operations goes negative 830 million in the most recent one. And I don't know how you manage a company like that. It just seems very difficult to manage. And it was sort of like what we're talking about with Peloton and all of that. Are you prepared when there is a downturn or something for that downturn? We talked about over-the-counter markets, which is, the extremely mild version of this. But I mentioned a little bit in that, it's in their release where they talk about their earnings and everything. It doesn't really show up in the quarterly results if you just look on QuickFS. But we had talked for a while about this non-professional user growth in the business, which is not the biggest part of the business really, but it grew very rapidly during the COVID stock craze for over-the-counter things and all sorts of different things, and just like rapid trading of things and all that. And a lot of people probably hadn't been trading stocks a lot previously. And they were down 50% in terms of number of users of that, right?
Mm-hmm. Yep.
Yeah. The professionals are never going to change by 50% like that.
But we didn't underwrite that going forward as being like a normalized thing.
No, what I'm saying though is their earnings were about the same with a 50% drop in one part of the business.
Yeah. Mm-hmm.
Right. 50% drop in terms of like
there was a boom.
Mania. You're right. Speculative mania drove some higher earnings, But when that speculative boom, the first part, now there'll be more. There's more to come yet because we haven't seen them report all the periods where the speculative part has declined. But for instance, yeah, you can see they reported revenue growth. They shrank 1%, right?
Mm-hmm.
And operating margin declined from 42% to 34%. You had a decrease in earnings, but year over year, the decrease in earnings was not very
not
big.
like Coinbase.
Yeah, it was about the same
on a cash flow basis.
Yeah, so you had barely any change that way, with a huge decline in that. What I'm saying is that a different business model has a similar decline, and Coinbase presumably will be larger than that. But let's say that wasn't true. It can have sudden declines in revenue, obviously.
I mean, so if you were a bag holder in this company, I mean, they'll never see valuations. I mean, I don't want to say never, but I mean, if things are normal, but if things are normal, I mean, 10 years, 15 years, 20 years. My initial thought when I was looking at this company was, if you bought at the IPO, maybe you'll make your money back in 20 years. I mean, what are you betting on? Another speculative mania?
To be honest, I think it's unlikely. We don't want to get into market dynamics, but it's very possible this company will burn cash and never generate profits again. Because that's the issue when I talk about over-the-counter markets versus other things. Over-the-counter markets, if there had been significant competition, it's not, that will slow down your growth. It's that you would no longer be the only market for everyone to use. And it would shift. You would become the MySpace to Facebook. Mm-hmm. It's not, MySpace grew a little bit slower. It's that it imploded. And that's going to be the case in a lot of these sorts of things. That's why you were earning such ridiculous profits in some periods. If you become the place. It's a winner takes all sort of, usually in these businesses, winner takes all sort of advantage that you have. And sometimes the speculative mania can fuel an initial advantage that you get that you can then maintain in future periods. But actually, I think we've talked about this before, just last week. Too rapid a growth in certain markets is a problem because it invites too much competition, too much potential for fragmentation, and actually a more consolidated situation will be better for you longer term. If your market had been growing slowly and you have the sort of advantage that a stock exchange has or something, most of the stock exchanges in the world, for instance, and commodity exchanges, they had fairly slow growth fueling them, and they at times benefited from big speculative advantages, but you wouldn't have wanted to found a stock exchange in 1995, that was going to be all tech stocks and things. Yes, you would have made a lot of money for a while, but you would have invited too much competition. That didn't happen because it was already such a well-established market, right? So you already want to be that marketplace that has that advantage. There are, though, situations where that hasn't proven true. Like for a long time, I mean, like eBay has consistently made money since it was started. Now, it obviously lost market share, that it's not that big an online retailer versus what that market became. But it never fell into a situation where it wasn't making a lot of money. It basically got founded at the right time, made a lot of money, and continued to make a lot of money. It stopped growing, but usually that's not how it ends. Usually are either in a reasonably slow growth, but strong position like over-the-counter markets, or I don't know what other publicly traded like stock exchange things there are that you could compare it to, but you'd see the same sort of thing. That their profits and stuff grow nicely, and their earnings per share, but they're actually not rapid growth. There's not a lot of rapid growth in normal periods in terms of number of users. There's not a lot of rapid growth in terms, professionals and stuff. It's not growing out,
I think it would be easy to say, well, I mean, put yourself in their shoes, Geoff. What if you were experiencing unprecedented amount of growth like that? But then you look at a company like OTCM, and I mean, sure, like certain parts of their business aren't going to benefit from the speculative mania anymore, but I mean, they still managed through it, I would say, quite well.
My guess, I don't know.
Like you talk about like Amazon, right? They're going on a hiring freeze. They're laying off people. Right. They're getting rid of warehouse space. Mm-hmm. It's easy from the outside looking in to be like, oh, you guys overgrew during the growth, or you extrapolated that growth forward too much or whatever. But there are companies that do it right. I mean, then you look at like a company like Peloton where it's just, it's not a good situation.
Well, there's also often no opportunity to differentiate yourself and survive. So I'm not saying it's the wrong strategy. You have to grow as fast as you possibly can, probably, to survive at all. I've never said that Uber or Lyft have the wrong strategy. Whether they'll ever make money for people to justify the amount of capital that's been burned in the past. But I don't think that slimming down with a narrow focus that you're going to be more profitable when you know that there's a competitor who is going to achieve a scale that you can't. Unless you're able to have some sort of agreement between the two of you to limit growth, there's no workable way around it. It's a benefit to your customers, but it's a harm to the two of you that you're trying to grow as fast as you can. It happens in other industries too, though. Like, cruise lines and stuff happen there. Early days of airlines, as soon as you had deregulation, it became a factor. There was every incentive to grow very rapidly, to take on debt to grow rapidly, because you would fall behind others. Even when it wasn't just these companies were trying to grow their earnings per share or their size or whatever really rapidly. It was also understanding that if my competitors merge with each other, if they grow faster than I grow, they're going to have advantages I'm going to lack, right? If you're Western Union and MoneyGram, one of you can't decide that they're going to pursue growth all out and the other one doesn't do it at all, because if that continues for a decade or something, one of you is going to have much worse economics than the other one because of the scale involved. Same thing here. There can't be 100 different there aren't going to be a lot of different beneficiaries of the crypto stuff if you're doing the same exact thing. Now, there might be other functions that you can provide, and I don't know a lot about that because I don't know enough about crypto, but there may be specialized functions of doing different kinds of things, but you're not going to see a lot of it is the kind of thing that ends up with a winner takes all type situation. It doesn't look tremendously expensive. It's just that when something's not durable, you don't know, if we see EV to sales is 2, for instance, right? And the operating margin, of course, would be 20% or higher with a successful business model. So there's no doubt that it's cheap if it was able to maintain anywhere near the same level of revenue. We know some things because this is such a national and international phenomena that we know that although crypto has been around a while, a huge amount of the people involved are very recently involved in terms of the population, right? So it went from being something that was incredibly fringe to being something that's mentioned that literally, if you prompt someone to ask them, what is crypto, you'll get a response, whether right or wrong, from a huge portion of the general population. And that was not the case only a few years ago. So that's a really tough development. It's probably just the market growth is too rapid. And when you have really rapid market growth, you tend to have extinction of almost all the companies involved. Someone survives and makes a lot of money, but the failure rate is close to 100%, most of them all fail. I mean, look at those growth rates. Nothing that grows 1,000%.
Yeah, it's insane.
Yeah, nothing that's growing its revenue by 1,000% for any period of time. It is a market that
is a monopoly.
I mean, it's not a market. There are no. It's not easy to have a lot of survivors when you have that kind of thing happening. And also notice that you went. In terms of the problem with this is buying it now and then thinking, well, if I'm right, then I'll stick with it. And if I'm wrong, I'll get out at the first sign that I've changed my opinion on it. It went from growing at 300% to shrinking by 35%. Right? Well, there wasn't a lot of hint about a slowdown.
No. Yeah,
so it's something that you have to watch every week and say, okay, I'm going to predict what the next quarter is going to be.
Yeah.
So who knows, but I'm not sure it's a company that's going to be in a great position to survive a downturn. Do you want to look at balance sheet and stuff like that?
Yeah.
Okay. Yeah. Yeah. That's not great. Yeah. There's significant issues there. Now, the liabilities are mostly in the form of deferred revenue. Of course, presumably that rolls off really badly when you have any shrinking in terms of revenue, obviously. So it's not a predictable form of float. So that flows out. But, you can burn cash for a while here, but it's hard to say. I mean, we know how many employees there are. If we kind of run the numbers on thinking about that and if we go to the income statement for quarterly, we could get some idea of how bad this can get. Yeah. So SG&A, for instance, and R&D, look at that. They're spending $2 billion a year on R&D at this rate right now.
Yep, annually.
And they have $6 billion in cash.
And quarterly, it was $571 million. And for SG&A, it was $614 million.
Right. So you have 3 years of R&D on hand in cash.
Yikes.
So, you have a very significant SG&A.
Do you,
stuff.
when we've spoken about like Tesla, we've spoken about Coinbase, all these companies, it's like at the end of the day, it's still a car manufacturer. Or at the end of the day, you could look at like other brokerage firms and stuff like that.
Coinbase could No, Coinbase is the business model that you have the potential to achieve is astronomical. If you really believe that cryptocurrencies are going to be a giant asset class permanently, and that Coinbase is going to dominate, right? Then we know that, operating margins of 50% are possible, right?
Yeah, it's huge.
And so you can justify, we were talking about price to sales with was it Evolution Gaming? What was Evolution?
Yep, Evolution.
Okay. So this is the kind of thing that could justify if you said like what potentially in a model could you come with a price to sales? There's almost no limit to it. When it's growing that fast and you know that this is an industry that can have tremendous margins, and in fact, they'd already achieved tremendous margins in quarter after quarter. It's like Facebook, when we're talking about Facebook. It's not, you might not be able to predict how big Facebook would get and how successful it would be, but you could say that there's a point it could get to where it's a very, very valuable company. Tesla's harder. And Facebook and Tesla aren't radically different valuations in the market. They're radically different valuations, I should say. They're not radically different market caps and things like that. But I think it would have been a lot harder to come up with the idea that Tesla was going to be valued like this in the market. Mm-hmm. Even if I told you what its results were going to be, it would be hard to come up with a model 5, 6, 7 years ago that said, okay, here's what the numbers are going to be. What's it going to sell at?
Yeah.
You wouldn't have predicted that it was going to sell at these multiples, I think. That would have been hard to think that at this size, it's going to be valued at more than 10 times sales, right?
Which at the beginning of the year, valuation was way worse as well, or way higher.
Yeah, Toyota's not valued at 10 times sales, So, and we're at a size when we're talking about being comparable to really big car companies now, or we will be soon. So that's really hard to come up with those price to sales type things. It doesn't mean they can't pivot and figure out some other business that's adjacent that makes them a lot of profit and stuff too. But because some others have done that, Amazon and stuff. But yeah, I think Coinbase obviously had a very attractive story to tell in terms of like compared to other companies and what they did. Obviously that's true. We talk about over-the-counter markets, and obviously it's the potential and everything for them is a way better business, and that's a little tiny niche business. But you can see all around the world all these businesses that are incredibly profitable. So it's sort of like fintech stuff that way. Like if you say there's some payment processing thing that's going to come big in the future, you can look at all the big ones now and say, look how profitable they are if we achieve even bigger scale. So Front Door.
Yep, Front Door. He says a little interesting since it's almost back at the same price as during the post-spin drop in late 2018. Price of sales 1.3, while HomeServe has received an offer from Brookfield valuing it at 2.8 times sales.
Yeah. So I wrote up I did right above HomeServe, and I did actually look at Front Door recently because I looked at it when it spun off. Front Door is in the same industry, different country, and somewhat different business model than HomeServe. But HomeServe is something that I did do a lot of research on, and Front Door is something I looked at. I don't think Front Door's results have been great since the spinoff in terms of compared to what I thought they might be capable of achieving. So that's tough. But the price is obviously not too expensive.
Yeah, 1.5 times EV to sales.
Yeah.
10-year median margins on EBIT, 19%.
Mm-hmm. So it has a couple...
Which is declined.
Yeah, it has a couple sales channels. And one of the sales channels is not one that I love, which is through like realtors, basically. So like getting a home warranty. We could look at the business description, but this is like a home warranty company. So do they describe what is home service plans?
Uh-huh.
Yeah.
The company's home service plans cover the repair or replacement of principal components of approximately 20 home systems and appliances, including electrical, plumbing, water heaters, refrigerators, dishwashers. You get the point.
The name that would be familiar to Americans watching cable TV and stuff like that would be American Home Shield. That's the name that they use when advertising directly to the homeowning public. It is a business model I like. And so basically what you do is you pay for this warranty. So you get your warranty on your, your refrigerator, your dishwasher, whatever. And then you're going to pay a flat price, guaranteed sort of price for the service visit. Sort of like a deductible, same kind of idea if you were thinking of it as an insurance company. And you're going to have to pay that, let's say it's $50 or whatever for that visit. And then otherwise all you do is you pay premiums. You don't have to pay different amounts based on the actual parts and labor and stuff like that you have, right? Very attractive to market it to homeowners, especially older people like it a lot, people on more fixed incomes and things like that. And to plan ahead for those sorts of things and to smooth out the expenses and that kind of thing. There's some things I like about it on the supply side, so dealing with the repair people that you're going to have. I think there's some nice benefits there. And I think there can be good things in terms of improving retention. So I think there's good stuff there. On the other hand, with this industry generally, there's always going to be some complaints and that you're selling products that aren't necessary, right? But that's a typical thing of insurance type things. And this is effectively like an insurance company, although they don't really present themselves in this description, for instance, as an insurance company, but that's really what they're doing. And so, there's always a question of whether you're selling coverage and things that people don't need and how you're selling it. And so you always see a lot of critical coverage of companies like Front Door and HomeServe. And HomeServe had trouble in the UK with a regulator and things like that. So it's kind of like when we talk about the title insurance industry, mm-hmm. It has somewhat of a negative perception by the public, I'd say. You can see that gross margin is usually very stable, right?
Yep, very stable.
But operating margin is less stable. Right.
So what does that tell you?
Well,
it's a volume-based thing or not a pricing thing?
I don't know enough. I haven't been super impressed by the company since it was spun off. I think they could do better. Interesting,
because looking at it, you would be, revenue growth has been kind of in a great wheelhouse.
Considered it when it spun
Variance in margins has been decent.
I think I like the business model. The industry, they have a strong position in the industry, maybe more than I like the organization at this point. And I don't want to be too critical about the organization. There's not stuff that we're talking about that that's anything that they've done that in particular that is egregious. It's just that I feel like this could be there. I think there's possibility for better performance than what we've seen so far. I do think that. But that's happened with other companies before. There have been points where I've been felt that way about AGT or something like that I've liked their position in the industry and stuff, but I didn't always feel like they were necessarily making as much money in a given year as they were capable of. And, that does happen. I do feel this has a strong position in the industry.
Would you ever look at this and take the buyout offer for HomeServe of whatever it was, 2 times, and be like, maybe Front Door at 1.5 times or 1.3 times price of sales is looking a little bit cheap?
They're very, very similar business models. Mm-hmm. Very similar. However, there are similarities, like I said, to insurance. The similarities to insurance are on the side of marketing stuff and customer acquisition costs and retention of customers and how you do that. There are aspects of HomeServe's business, for instance, that I liked a lot. Their business in certain countries and certain ways of doing it through partners that they had. I do think that some of the stuff HomeServe did was smarter in terms of the affiliates they were working through and what they were doing. And I think in some cases they had really nice customer economics because of how strong the retention was. You have to be careful to grow in the right kind of way with this sort of company or with any, like I said, like an insurance company, because customer acquisition costs versus your retention and the lifetime value of the customer is very important. And like I said, there's multiple channels here, and I don't think the economics are the same between those channels. And I think there's different things they could do that could be more successful. The big difference between them and HomeServe is how it's marketed.
How does HomeServe market?
Affiliates. So HomeServe is focused, and they've even did things in the US and stuff. So HomeServe is focused on, let's say you have a utility company, like a water company is the best example. That's the best one you could sign up. But let's say you have your water company, right?
Yep.
You add on, so let's say $10 a month to your water bill as a option that you can check. It will be collected as part of that bill. And that's actually getting you coverage through HomeServe, but it's provided by is your local or national or whatever it is in those countries. They're usually much bigger in those countries. Utility, like a water company or gas. Gas is another good one to do. So it's connected in some way to plumbing, appliances, things like that. It's a regular bill you pay all the time. It makes it look smaller because it's a smaller fraction of the bill. It's also more invisible because it's like tacking something onto your monthly mortgage payment or something. It helps with that a lot. Whereas marketing, by trying to approach people through, say, advertising, like I was saying, like American Home Shield or something like that. I mean, that might be something that like runs ads on Fox News or something like that. That is, okay, but I don't know that the economics of that in terms of the retention and all the psychological aspects of it are as good as what I was talking about with the affiliate marketing.
Just how easy it is to do it like that too.
Right. And then of course, once you're using certain channels, then there's, you may be stuck more in those sorts of approaches than other ways that you could do, which is what happens to insurance companies all the time. That's why I keep comparing insurance companies, but selling through agents, selling direct, who you focus on, where you're doing it. I like it a lot. I mean, I also even like the product's economics in terms of what it's offering to the customer. I think that the customer actually, in some cases, is getting peace of mind for a fairly good price. I think in terms of the sort of effect that it has on matching certain people on each side, which is sort of what the service is basically in terms of the economics they're able to extract from it, is by providing work for people on the other, sort of guaranteed source of work at a reasonable price for the people who are actually providing the labor. And on the other side, kind of capping your potential costs and smoothing them out for the homeowner. I think that those are both really desirable things for each of those groups. And you can capture a fair amount of profit for yourself there by taking out kind of the variability for them. And so you're trading that off, taking that as a company. You're getting a lot of profit from that. They, in a sense, are giving up the potential to have a lot of profit, but having more predictability. And that's often a good business to be able to do that, to provide a more predictable sort of thing to people on both sides here, matching the supply and demand. And in exchange, you're making money off of this and having this network. It's very interesting business to me. It's definitely an industry I'm very interested in and a company I'm interested in. Has higher share turnover and stuff than what we're used to, and it's a bit bigger, but not huge. It's $2 billion market cap.
Mm-hmm.
Yeah.
2.4 billion EV.
If I was looking for companies in a couple $1 billion range, it's definitely something I would look at. It's come down a significant amount there. I'm not sure what that's all about in terms of why it went up as much as it did and then why it went down as much as it did. Can you look at the, hold on, if you go a little bit higher, they have a bit of debt. So let's look at the balance sheet. Let's see how that's progressed since... Yeah, that's what I figured. Yeah. So
it's gone from 10 million in 2016 to 608 million today for long-term debt.
Right. And they also have short-term. They have short-term, but that's not where it went. Deferred revenue. Okay. Yeah. Because that was an issue in terms of the EV wasn't as attractive at the time of the spinoff as the market cap might make it appear. Here, that's, not only that, they have 600 million in long-term debt and a little bit in short-term, but they do have 200 million, it looks like, on cash on hand. Can we look at the cash flow?
Yeah.
Okay. So it was, but to give an idea, it was kind of leveraged in a sense before, in that, as you can see there, it didn't have retained earnings until very recently. So like from a book value perspective and things like that, it would have looked very leveraged. It doesn't have a lot of tangible aspects to it, and it obviously had that. So let's see what we have. Yeah, I mean, you can see, as you'd expect, in terms of cash flow from operations versus Capex, capital light and predictable.
Free
In
cash
fact,
generative.
the cash flow from operations is probably more predictable than the income. Although the income's been no, the cash flow from operations is more predictable. Yeah, so let's see. Your debt on a gross basis, your debt is 4 times your free cash flow lately, but you've not had worse free cash flow than that before. So 4 times free cash flow, I can deal with that. That's not a problem. And then also, that's not taking into account the fact that you have cash, so it's even less than that. We're really talking about maybe less than 3 times. Yeah, so I mean, and that's in terms of an actual debt to free cash flow, not like EBITDA and stuff like that. So I think it's manageable. I don't see that as a problem. And they even bought back a little stock, right?
Yep. So if you 100 million. So if you were focusing on companies that were a couple billion, you would focus or hone in a little bit on Front Door, learn a little bit more about it.
Yeah, I don't know. I mean,
what are some things that you would want to learn?
I don't
more
love the
about
revenue growth that we're seeing the last 4 years, for instance. So it's very stable revenue growth that you're having there, right? But it's not particularly high given the level of inflation that we've had and everything that happened with COVID and all of that. And it's really translating into basically no growth in operating profit, right? We're at the same level that we were about 5 years ago.
Yep.
So, I mean, it's one thing for your margins to decline. We've seen that with other companies where you have a decline from 20% to 15% or whatever we're seeing here. But to have that decline without being rapid growth offsetting it.
In a capital light business.
Yeah. So I guess that I don't know all the reasons for that. And it would be interesting to look at that and to figure out what management's explanations for that are. Why? I mean, are you really capable of growing 8% a year? Because when you were growing at that rate, your margins have been contracting. If your margins are contracting, couldn't you grow faster if you were accepting lower margins than what you're doing? Because like I said, it's marketing driven sort of thing. You'd think that you could stimulate more demand. More advertising and different kinds of pricing and sorts of ways of doing it should be able to drive a lot more people to sign up if you want to. So you think that, this isn't something that's like selling groceries or something. There's a level of, you're convincing people for demand for this product. So you're capable of growing faster at different economics for you. So I don't know that I like that we're seeing margins. Basically, margins in the last 2 years or so are significantly lower than what they were from 2015 to 2017. They're like 5% lower. That's really significant when you're growing at 8%. So it just makes me think, well, are you really capable of growing at 8% because your margins did contract? Or does that give some sign that maybe you're not really capable of growing at that level?
It's like a quality of earnings thing.
Yeah, which I could live with if that's not the case. But, with any kind of company like this, I'd worry that people would look at the growth rate and say, okay, this is what they can do. But again, like an insurance type thing, you can grow faster if you're willing to advertise in customer acquisition cost sort of way that doesn't make as much sense, and if you're willing to price things differently. So you certainly are capable of faster or slower growth, and sometimes slower growth might be better if if it's converting into more profit growth for you. So it's a question of the company having to be realistic about that. As you can imagine, it's all in the operating profit line that the problem is, right? So it's all operating expenses that are causing these problems. All operating expenses. The gross profit progression is exactly what you would have hoped for. If I was looking at this company when it spun off and thinking forward to today, gross profits proceeded exactly like you'd hope for. We can see it each year that way. But you're making the same sort of operating profit now as you were 5 years ago, and on a lot more gross profit. You're almost 1.4 times more gross profit than you had before in dollar terms, and yet operating profit is the same. It's like when we talked about Village and said, look at the last 10 years, how they've progressed in terms of gross profit, and they've converted no more of that into operating profit. So it's expense line stuff.
Let's see what we had a lot of requests of.
But very interesting company. I did look at it when it spun off, and I would definitely, if I had to look for things in the couple $1 billion range, I'd definitely look at that. Front Door.
Somebody said, have you followed up with Points International?
Oh.
At all recently? They're getting acquired.
Are they?
So I think if you buy any stock that we sell,
then it gets acquired.
It gets acquired.
Mm-hmm. That's we've got. If that's true, we've gotten at least 3.
I think.
Yeah.
So, let's see where.
Yep.
Where is? So I'm trying to find a PR on it.
Can you find it? It trades over it trades on NASDAQ.
NASDAQ, yeah.
So maybe if you go to over-the-counter markets and then go to news or disclosures, it might have it. Because PCOM is the ticker in the US, right?
Yeah, let's go.
Canadian company, but I believe it trades in the US. PCOM is the ticker you're looking for in the US?
Mm-hmm.
Yeah.
PCOM. Let's see. No news. Okay. Disclosure. Let's see.
Nope.
6K.
Was that recent?
516. Let's see what this is. Can they hear that? There's a storm going on.
There is a storm.
Yes. So let's see. After the close of markets, company entered an arrangement agreement.
Who is acquiring them?
Plus Grade LP will acquire all of the issued and outstanding common shares of the company for $25 a share.
So US $25 a share.
Yeah, US.
Okay.
There you go. Any thoughts on it? And here we are.
So before COVID, what were they at? 15 or something? What was their price around then?
Yeah. Uh-huh.
And then they spiked?
No, so 10 to 15.
10, immediately after COVID. It was like 15 when it was 17 or something before they announced that stuff. Yeah. So, airlines have recovered a lot.
Yes,
this is a great business model. Huge amounts of deferred revenue, as we talked about.
Capital light.
Generates
a ton of cash.
If you want to take it over using debt, that will work in anything except if we have another COVID experience, and then you'll be bankrupt. But also, I think airlines are willing to work with other companies, and it turned out that governments bailed out airlines and all that.
Interesting. So you have not looked at that company recently?
I've not looked at Points International recently. So there's no spread on it?
No, there's not. It's
We should mention and warn though that like if you go to QuickFS, I think we'll give you an idea here. The let's see, because QuickFS will have both. Will it?
Maybe not.
No. Okay. Could you choose Points International and let's see.
Nothing.
Do you have internet? Yeah.
Yeah, we do. There's a huge storm going on right now as we record this.
It's a huge storm. There's probably some power.
There's probably like a tornado going on. Our light just went out, but I mean, our cameras are already turned off, so we're just recording the screen. So we're just gonna keep it going. But yeah, I don't know. I'm flying dark right now, Geoff. I'm flying blind in the middle of a storm.
What happens if if you lose power?
The show goes on. We have our stock.
We don't lose our files. Okay.
Yeah, we're good.
Yeah, so all I was warning about is I believe it has a lot more volume in Canada than the US. Do you remember if it does?
That's correct, yeah.
Or it has a lot more...
No, it has it trades in Canada and it trades on the NASDAQ. I think we bought NASDAQ because I thought it had more volume, but I could be wrong about that.
Oh, okay. That might be true, yeah. I don't remember which does, but just be careful when you're looking it up. It's unusual if you see a NASDAQ listed stock, you're going to think, I mean, they're Asian stocks that are listed on NASDAQ, but you're going to think that it isn't also, since it's not over the counter, you're going to figure it's not also listed in Canada, but it is listed in Canada too. And so I think there's a significant difference in like share turnover and stuff like that. Like some of them may be more actively traded, one or the other. So just be aware of that. But if that's correct, then there's no spread basically, right? You're talking about
$25 a share, and it's
so they're certain that deal's gonna go
24.
That is interesting. Imagine a couple of years ago if we were saying there's gonna be a deal involving an airline points thing, and there'll be no spread on that, but there'll be huge spreads on video games and on Twitter, right?
Mm-hmm.
Yeah.
Let's see. The Rational Walk, second DVA. I just spent a week looking at it, but I don't own it. Alrighty, we are back. We are not flying dark anymore. The internet did go out, but now I'm connected to a phone. Mm-hmm. This is why we need Starlink. That's Elon Musk's thing that shoots up to the satellite.
But it's a satellite. Does it work?
Yeah, I don't know how that does in the rain. I don't know. But okay, we're back live. So Points International. So they do have one on QuickFS. It's just our internet was down. Huge share turnover.
Right.
But this
so
is
I think that's the NASDAQ.
Version.
Yeah.
Mm-hmm.
Yeah. And so no spread. right?
No.
Because we said the offer is $25 and
Yep.
this is $24.44.
So no spread.
Nope. So not an 1 to arbitrage. So maybe people think there might be a bigger offer coming along, or maybe it just seems like a certain deal. And that was just a recently announced deal.
Yeah, it was announced, I think, on the 15th, it said, I thought. Forget, but recently, a couple weeks
We
ago.
can look at the ratios if you want on it. So people get an idea of what
Points?
what it's going, being taken over at.
Okay.
Right. So revenue is not quite back to where it was before COVID on an annual basis.
Nope.
Right.
So pre-COVID, 2019 was 401 million. 2018 was 376 million. And we're currently sitting at 370 million.
Right. So on a market cap basis, it's a little over 20 times peak pre-tax profits. Their peak pre-tax profits were at 17 million. And then this, would be more than that. It'll be 20 some times. But on an enterprise value basis, obviously a lot less because they have huge amounts of deferred revenue. We could go to the balance sheet to show you that the free cash flow is going to be different. When it's growing, it's going to generate a lot of free cash flow. So you can see total liabilities, 90 million, but total current assets, 126 million. And the liabilities are going to be largely, actually they show up as accounts payable here. Let's see. Okay. It's basically a form of deferred revenue, though. So
It was float.
I'm not sure if that's accurate, but yeah, if we go to cash flow, that might give us a better sense. So if you remember, I said they generated 17 million in 2019 of pre-tax, so operating profit, but post-tax they had 23 million in free cash flow. So after paying taxes and everything, they still generated quite a bit more. Like 30% more in free cash flow than in operating profit. So that's the unusual part of this business. If you look at it on like an EV to EBITDA or market cap, like a PE basis, it's not going to look that cheap. If we go to the overview, the PE is not going to be low for years in which, well, it has like no earnings right now. So the PE is 100 or something.
We go pre-COVID, though.
Right. So, but the peak earnings per share was 54 cents
Yep.
a share. So even then you're still talking about,
Nope, 86 cents a share.
86 cents. Okay. So, you're still talking about, 30 sometimes, PE. So a very high PE, but on a price to free cash flow basis, not nearly as expensive. In fact, it's in the teens, the price to free cash flow, if, comparing it to the peak before. So if you kind of use free cash flow as the more important number, then that's what you get. Now, if you ever use EV to free cash flow, that's always going to look incredibly low, because your free cash flow is high because of the business model, and also your EV is incredibly low because you have a lot of cash on hand, right? Because what is happening is you're not counting as debt the deferred revenue, so it's kind of like over-the-counter markets that way, right? When we look up over-the-counter markets, people always say the EV to free cash flow looks very reasonable, more so than the PE, and that's the case here.
And what do you care about more?
It depends. The acquirer probably cares more about the EV to free cash flow, depending on who the acquirer is. But with the current management team in place and stuff at any of these places, then you're not going to think that they're going to use the enterprise value quite the same way, So to an acquirer, EV to free cash flow is going to matter a lot. That's how you're going to think about that. And that could matter a lot with points. Both of them have the potential for a lot of financial engineering. They can take on debt. They can buy back stock. They can do all sorts of things to make the deal more beneficial, like a lot cheaper to someone financing it.
All right, so let's look at DVA. Have you looked at this company? Davita Inc.?
So I've not really looked at Davita nearly, certainly not at all recently, and nearly as much as most people do because of the Berkshire connection.
Provides kidney dialysis services for patients suffering from chronic kidney failure. So another healthcare company. Current PE, about 10 times. EV to sales, 1.5 times. 10-year median margins on EBIT, 15%. Currently trading at EV to free cash flow of 11.7 times. Gross margins looks like in the ballpark of something that you would be interested in, like the variability of it. Very low variability. Hasn't really jumped
Very
around
low
much.
operating margin.
Very low operating margin, yeah. So from like a factor quantitative perspective, this is something that Geoff would be interested in. Maybe a little bit more revenue growth. 10-year CAGR on revenue has been 5.6%, but over the past 3 or 4 years, it's been basically not moving around much at all.
Right. But look at earnings per share growth versus revenue growth.
Yeah. But they've been able to improve gross profit, EPS, operating profit during that time.
So it looks a lot like if you're familiar with the testing companies, so your companies like your LabCorp or something like that, a lot of the economics, the variability, the margins, things like that we're seeing are very, very similar. And presumably the business is pretty similar, although you're dealing with a much smaller but more consistent customer base. Because you see they have, 2,815 dialysis centers? They're really small. Mm-hmm. And the dialysis centers are only serving 200,000 patients?
Yeah. Right? Serving approximately 203,000.
Yeah, so you're serving way under 100 patients at each center.
And operate 339 outpatient dialysis centers located in 10 countries outside of the United States, serving approximately 39,900 patients.
Okay.
So thoughts on Davita?
Let's look at the free cash flow statement to look for capital allocation. What is their approach to share buybacks?
They buy back a lot of stock. Mm-hmm. Basically, all of their cash flow. Or close to it.
Actually, more than their free cash flow, I would say. It's close to their cash flow from operations, to be honest. It's certainly, the acquisitions are certainly funded.
It's more than their free cash flow.
Yeah, it's definitely more than their free cash flow. So if you're taking 100% of your free cash flow and buying back stock, that's something I'm interested in. Now, we have to look at the income statement to make sure they're really getting the share count down. And let's look at that.
Yeah, so shares outstanding in 2012 were 196 million. And in 2021, there are 110 million. So they've reduced it a pretty good amount.
Right. Oh, yeah. On a diluted basis that we're looking at there. Absolutely. Yeah. So I think that this is a very interesting stock because it is very slow growth.
Looks like VeriSign.
Yeah. It's very slow growth in terms of the actual revenue numbers. But it looks like you have a predictable capital allocation. And let's look at the balance sheet. Yeah. So there are some issues here, and I thought this might come up in the balance sheet. You have a very weak liquidity position. Very weak. Total liabilities are $14.7 billion, right? Which is overwhelmingly long-term debt. There's some capital leases too.
8.7 billion.
Right, 8.7 billion in long-term debt. You have 462 million in cash and equivalents. There's some other stuff. Let's take it down, say it's 8 billion or something in long-term debt. Then let's look at cash flow.
Was it like 2 billion?
Yeah, in operations. Mm-hmm. Yeah, cash flow from operations lately has been about 2 billion. So you're at 4 times debt to cash flow from operations. And there's significant Capex. I mean, it's not nothing. They're paying almost 30% of cash flow from operations on Capex. They're also making acquisitions. So your free cash flow in some of these periods is in the low billion range, not closer to 2 billion. And then you're using all of that to buy back stock. So we get to the important question of whether what they're doing is right and going to be successful or not. And I think it comes down to business model. If what we're looking at here is like we were talking about with VeriSign, this may be the right way to run the business, is with a lot of stock buybacks, a lot of debt. With the example of IMS Health, I only bought that company because it was using everything to buy back shares. And in fact, it was willing to have debt and all of that kind of thing. So that was really significant. And I thought it was appropriate to put debt on that company. And the private equity firm thought it was appropriate to put even more debt on it. And that's why it went private. So this looks like a kind of setup for a private equity thing. That this would be a very logical LBO sort of thing, right? And they're kind of getting halfway there in the public market by taking an approach which is halfway towards what a private equity firm would do and what a public company normally looks like. Looks really interesting that way. I'd have to read more about it to learn about if it's as predictable as it appears to be. I'm sure there's always risks of like regulation and things like that. But obviously, based on the past numbers, it looks incredibly predictable.
Incredibly predictable. It screens very cheap. They're buying back a lot of their stock. It looks pretty safe as well. Like you said, we'd have to learn more about the business model, but from like a quant perspective, this is what you would want to see. the
Yes.
company look like if they're taking on a bunch of debt to buy back stock?
Yes. Now, the warning here is that the 10-year median EBIT margin is about 15%. The EV to sales is about 1.5. For a company that's not really growing more than 5 to 6% a year or so, that actually is not that unusual. So it's about 10 times in terms of the price that you're paying. You're paying 10 times pre-tax profits, or what you'd expect it to be. So, you tax that and then you take that in the form of a PE. It looks fairly normal, not expensive, but fairly normal. It's like a very predictable company, but that's not, in normal times for the market, that's not a weird price to have. However, on a leverage basis, it's very cheap because the price to sales is 0.8. So a lot of this is capital allocation and the benefits that you're getting from that in terms of buying the stock, the equity, as opposed to buying the entire company. And I think that you'd have to learn about that, but it's kind of the thing that gets me interested in Stella-Jones, which we talked about before, which is the capital allocation, how long it's been going on, all of that. If you have a very predictable business, this is how you have to run it, or to get really amazing returns, this is how you have to run it. They are capable of taking on a significant amount of debt and buying back a lot of stock, and that can really change your returns. So it's sort of like an outsiders type thing. If you read that book, you look at that in relation to this company and how it might generate returns for you.
Have you looked at Stella-Jones recently?
Mm-hmm. It's come down a bit. I don't know if it's come down in the last few months, but I was a little surprised by that. However, it sells some, I think it uses a dash in between the name.
Got it.
It's also in both Canada and...
There we go.
That's the over-the-counter one,
Over-the-counter.
yeah. Mm-hmm. So these numbers are going to be slightly different because this company actually, although most of its business is in the U.S., it reports in Canadian dollars, and then that's being translated over here. There's two stocks. But it's very, very similar. The numbers will be almost identical if you look it up in QuickFS under each ticker. So this company is Stella-Jones, is very predictable. What I was saying is I think one reason for it coming down, we could look at the stock chart, is probably related to one of the things it sells, and this business has gotten bigger for it recently. OTC markets, we'll just call it Stella-Jones. So it's come down a little bit. Let's see, that's not that different from the S&P, right?
No. Mm-mm.
Yeah. So it's probably come down in line with the market or something like that. Which, would be a little bit surprising because it wouldn't be that affected by recessions and things like that normally. And it's cheaper than it normally is. So that's all would make a lot of sense. However, what might concern people a little bit is that in recent years, a bigger part of its business has been selling treated wood for like decks for outdoor stuff, sold through like big box, like a Home Depot, that kind of thing. That business might be expected to turn down a lot, to be very related to housing and things like that. I wouldn't expect the railway ties and the telecom poles to be affected as much. The power electric, yeah. So it's basically utility and rail are the two things that use the majority of their end demand for their products.
Yeah, I was going to say, is the deck a huge percentage of their revenue?
It wasn't until recently, but they have an investor relations thing. I bet we could see, they have extensive investor relations. We could see how big it's become in the last couple years. And then they also the other thing is they normally have a part of the business that's just meant to dump sort of product that they don't need. So it's actually meant to kind of create a loss for them. It's like lumber and other, something they'll call it. It just generally would create a loss, but because of lumber pricing stuff, I think they may have actually generated some profit in that when it's just a way to recoup some, like there's a slight gross profit normally from it, but it's just a way of kind of liquidating stuff. If you just look at their presentations, events and presentations.
Yeah, I clicked that. It said there's an error.
Well,
you wrote this company up for Focus Compounding in 2019.
Yeah. But it's changed a bit due to changes in the housing. Mm-hmm. That's the only thing I can think of is that people might be concerned about the business if you go up, residential lumber. So it's 20% of sales. Obviously, utility poles and railway ties are not going to be affected. And even industrial products, not really. They say industrial products, but it's a little complicated what that is. But it's industrial demand isn't a driver for it. But you also see logs and lumber. What does it say about that?
Logs and lumber, 9% of Q1 2020.
Down from
2022 sales.
Yeah. So
down from 65 million. It was
right.
57 million. So down a little bit.
So there was some change in that too. That's normally a very small item for them. And I think lumber prices may have gotten a little crazy. And so that affected things. But even if we add all that together, you're still getting that railway ties and utility poles and railway ties are 2/3 of the business and most of the profit, and certainly most of the durable profit from the business. So I would have expected that it would not be as affected as the S&P 500 generally, just because the business is much more predictable than that. It is a little sensitive to capital costs because it does borrow money all the time. So there is a little bit of that going on. And the reason why they do that, they're permanently leveraged, is because it takes a long time to hold the inventory. That can't be avoided. They need to season. It literally has to be a certain period of time before they're able to use the product. It's almost a year, I think. So they're going to offset their inventory generally with debt. If we see debt was 550 million long-term debt and was short-term, yeah, again, pretty close to inventory. I mean, it's going to move around because you might have bought your inventory later, so it might be inaccurate in a certain period. But I would say as a rule, they're deferred revenue too. You could add that into it. But they're basically financing their inventory. That's the way that I would think of it. It's not really the financial engineering that they're planning to have a lot of debt so that they buy back stock or do an acquisition. It's really that they expect to be permanently having some debt to offset their inventory because it doesn't turn fast enough. And you can see that if you go to the income statement. You're going to see that the margin, or we could go to key ratios. It's easier. The margin there is okay, the operating margin, but it doesn't convert into a very good return on tangible capital employed because you're only turning your product about once a year or something. You can see the two numbers are very close to each other. So, if your operating margin is say like 15% or something, and you're noticing that your return on capital is also about 15%, then obviously that means that you're only selling through your product once, and you can see that in turns. If we go to overview, we can see that the stock is pretty cheap. So why I say it's pretty cheap is price to book is 1.5 times. Yeah, you could use price to sales. So the two ways of looking at it that are usually much more predictable in things like earnings and stuff like that for a company would be we either compare it to book value or to sales. So we use price to book 1.5, and then we compare that to return on equity 16%. 16% divided by 1.5, we're above 10% return on equity, earnings yield normalized there. Similar with the EV to sales or price to sales, because we're always going to have leverage here. So it's really price to sales we care about. But EV to sales is 1.1 times, and EBIT is a little bit better than 12%. Pre-tax income is 11.3, same idea. It's all telling you about 10 times. Now, interestingly here, the PE is also saying about 10 times. So I think from all of that, we can kind of triangulate that you're getting about 10 times profits here, after-tax profits, but not cash flow. So if we go to the cash flow statement, you can see that this company is not going to generate a lot of cash flow for you. Right. So net income last 3 years was 124 million, 164 million, and 177 million.
Yep.
Yeah. But the cash flow from operations was only 68. What do you have there?
139 and then 196.
Okay. So you were higher in one part there, but then you also have the Capex that you need. And this company also sometimes does acquisitions. So free cash flow is significantly below reported profits. That's always going to be an issue at this company. You have to kind of be okay with that. And if you're getting a 15% return on equity leveraged up, when you're using 1.5 times leverage or something, then you're going to probably be happy with that. You're going to say, okay, keep reinvesting in the business all the time for me. I don't need to take it out in cash. And then in terms of cash, they use it to buy back stock. However, they also do pay dividends, right? Buybacks are bigger than dividends, though. Mm-hmm. Yeah. So, and then they also made a disclosure that interested me a lot. Actually, what interested me was they had this little graph. This was going back maybe a year or something, where they kind of said what they plan to, it was their capital plans for the next, I think, 3 years. And it was very interesting in terms of what they said about how much they expected to use in dividends and buybacks. Because I was looking at relative to the size of the company, some hints about what that meant. Like if they're saying, because we know that they only use it for Capex, for acquisitions, they buy back their stock and they pay dividends, and it added up to a very nice number that suggested that they expect to generate quite a bit of free cash flow and that they would use a lot of it to buy back stock, for instance. But just in general, that they were going to generate a lot of free cash flow under that plan, if that's what they thought that they were going to have that much to allocate. So I thought that was very interesting. That it's just a small little graph that they included. But I thought it was very interesting, and that's what got me interested in it recently. It wasn't actually the price declining kind of in line with the S&P, but that little paragraph with that disclosure about their capital plans in the future. So, of course, they could change those. Who knows what could happen. But it was that capital allocation plan that interested me. What do you think about it from looking at the overview?
Seems like a company we'd be interested in. We like the return equity numbers. It looks like it's pretty, not expensive. Would need to learn more about the business model, but it's kind of utility like, right?
Yeah, it's almost all replacement demand.
Yeah,
so railway ties and utility poles, obviously, neither one is new demand.
When I brought this to you a couple of years ago, whatever, I figured just from the business model, it's something that I thought you would be interested in. And I think last time it was the leverage. I thought that maybe turned us off a little bit.
Okay.
From 2019, circa 2018, 2019, when we were looking at it. But
well, what was the price back then? We could go look at
key ratios. This is market cap was at 1.9. 1.9 billion.
Yeah. So, obviously it depends on the exact date and stuff. But this company has been at around this sort of market cap for much of the last 10 years.
Mm-hmm. Yeah.
And yet the earnings have come up.
Which is something that we love to see.
Right. So the multiples have come down. Mm-hmm. Part of that could be a lack of future growth prospects. If you look, there's been a significant shift in terms of the share count coming down now. And I think, although the acquisitions look like they're still happening, the company's gotten bigger, so I think that's somewhat misleading. I think that you're seeing less growth and less organic growth, or not organic, but less growth of the overall business, both organic and by buying things, versus reducing the share count to drive earnings per share growth.
So we're talking about capital allocation here.
Right.
Would you rather see a situation like Stella-Jones or Davita?
I think they're very similar. Yeah. Now, Stella-Jones isn't pushing things as far as Davita is.
I was going to say, Davita looks more predictable.
Really?
Like the actual business itself, less variance in the numbers.
Well, yeah. They have input costs, Stella-Jones.
More of its net income converts to cash.
Davita, yeah. That is a big issue for Stella-Jones, is that this is not going to convert to cash. And sometimes you got huge amounts of inventory that you have, especially when prices go up and all that. And inflation will be interesting how it affects both Davita and how it affects Stella-Jones, yeah.
Because somebody actually asked, I have it on a presentation I scrapped because we're going to do it for next week because I figure markets the turmoil, whatever. Somebody asked how you think about free cash flow when a lot of the Capex is growth Capex. So they generate a ton of cash, but they're also plowing it back into the business. How do you think about that from like a valuation perspective?
Yeah, that's hard. I kind of worry about it not getting as good returns in the future. Because that asset growth is my big concern. That companies and industries that grow assets are likely to have worse returns in the future than they do currently. I believe that's true we're seeing that. I think we talked about it a little bit. I said, Amazon's investing like as much as a U.S. railroad during COVID. And look, it turned out to be too much. So their returns on capital are coming down. They're going to be worse because obviously they ended up with more space than they needed. Any company's capable of doing that, even companies like that. So I think that's always a risk. And so, although it sounds good when companies say this, like, we can expand and here's the return that we get on our Capex, right? So in theory, in a model, if they say we can get a 20% return, even say it was a 20% EBITDA return on the capital that we invested, then you say, okay, well, that will create more than it'll create at least $1 value, maybe more if we use EBITDA, for instance. So for most companies, if you're going to spend $1 to get 20 cents a year of EBITDA in the first year, that return will actually create more than $1 of market value. So your stock will go up to the extent that you do that rather than, say, pay it out in dividends or something. So that kind of thing, if they can hit a number in that range of 20% plus EBITDA, that's probably going to convert into things in terms of free cash flow, earnings, whatever. That's going to get you a higher stock than you would if you didn't, than if you generated free cash flow. So it's actually better than free cash flow to do that kind of Capex. However, a lot of times you overestimate what your future returns will be because you aren't taking into account that you're increasing supply more rapidly than demand is. And also, if you're doing it, probably your competitors are doing it at the same time. You know, it's like Buffett says about being at a parade and everyone stands on their tiptoes. Mm-hmm. That may also be what's happening with Amazon too. Maybe a lot of other companies are doing the same thing, thinking the same thing. Maybe Walmart and Amazon are doing the same thing at the same time. That's a problem. So you're not only taking into account that you may have overestimated what you're doing, underestimated how much new supply you're growing too fast, but also your competitors may be doing the same thing and you're affected by both of them. So that's why I like things like Stella-Jones and Davita. Honestly, that's why I mentioned Stella-Jones in relation to Davita, is because both of them have modest enough real growth, very modest real growth. And so you don't have big increases in the possibilities of big miscalculations. Mm-hmm. In a sense, they're both replacement type businesses. I mean, Davita is a maintenance type business. It's basically a health maintenance situation. And Stella-Jones is literally replacing almost all of the businesses, replacing existing capital in the railroad and utility. So I think they're similar that way. Now, let's see. What do we have here for the let's go to the balance sheet for Stella-Jones. They have long-term debt of $550 million. Is that right? Mm-hmm. Okay. It says no cash. So that's interesting. My memory is I don't have in front of me. My memory is that they draw on a credit line and that they're funding inventories that way. They do operate with nearly no cash at all times, but literally here it was saying zero cash, which seems unlikely. But so the most recent quarter is $730 million in long-term debt.
Yep.
Okay. They also have capital leases. And then let's go to cash flow. So here's the issue, right?
You want quarterly or annual?
Annual, please. So from the thing we just did with Davita, the problem that you have here, right, is that cash flow from operations is only $200 million.
Stella-Jones, not Davita.
Yeah, Stella-Jones is only $200 million. And then you have Capex of like $50 million. So at best, you have $200 million in cash flow from operations, like $150 million in free cash flow. Your debt situation was around $800 million. So that's about 4 times cash flow from operations. And even higher number when we're talking about free cash flow, which is not that different from Davita. Now, a difference, though, is if we look at the income statement, we're going to see that a number that's often used is operating profit or EBIT, right? EBIT is $250 million. And actually, if we ignore capital leases, which makes sense when I'm doing operating profit just because of how this works, because I'm not adding it back because I don't have that number in front of me. So we have to use operating profit against debt. Debt was only $750 million. So it's 3 times debt to EBIT, which actually is appropriate. It's not excessively conservative, but it's appropriate for something like Stella-Jones. I think that's a good number to target. In fact, I think they target that as the top part of their range or something. But 3 times debt to EBIT makes sense. Davita looks a little... Davita actually has more debt in relation to some of the numbers we look at. So if we look at Davita, let's see.
You want their balance sheet?
Yeah, go to the balance sheet. Okay. And then if we look at their income statement. Yeah. So if we look on an operating profit basis, they're actually higher in terms of debt to EBIT. You're going to be at a whole nother turn at least. So in fact, a little bit more than that. So they have over $8 billion in debt, and they have quite a bit less than $2 billion in operating profit. but actually because of the cash flow dynamics, they're perhaps a better credit risk than Stella-Jones. On the other hand, you could say, well, look, the quantity of inventory that Stella-Jones has does potentially mitigate a lot of the credit risk, but I think it's harder for people to evaluate. Most people aren't used to evaluating the value of inventory, although it's huge in that case. So I think they're not that different to me in terms of their credit risk here. By the numbers, Stella-Jones would look somewhat better, but in terms of a business and the cash flow dynamics of it, Davita would be the better credit risk.
Which would you rather own?
So Stella-Jones maybe has a little bit less risk from regulatory and government policy, those sorts of things, and maybe even technology stuff. It feels like something that there'd be less efforts in that could kind of risk the durability of the business that way.
Compared to Davita.
Yeah. Because it's a more sensitive topic, Davita. Mm-hmm. Even in the case of Stella-Jones from a government perspective and stuff, while their customer is definitely a sensitive topic, utilities and railroads, suppliers into them are not a sensitive topic for government-wise. Now, Stella-Jones, though, does have, I've always wondered about their environmental situation, because they are doing some things that have some health risks in terms of what they're doing with the product, the process involved. And I don't know enough about that. And I don't know if at some future date, things will be, there'll be questions about whether people were exposed to certain things. It just seems like there will always be some potential for that with what they're doing. So with the way they're treating wood and stuff. So, maybe that balances out or something because you don't have that problem at Davita. I'm just less sure of the future trajectory for a dialysis, than I feel like I would be for a demand in rail and utility. Of course, people could say, well, they could replace with a different material, obviously, in those businesses.
So Stella-Jones.
I think they're very comparable. They're very comparable on price, very comparable on capital allocation. I know they're in totally different industries, but
totally different countries.
Stella-Jones is really in the U.S. It reports in Canadian dollars. It's a Canadian company, but it's mostly U.S. and some Canada. So I think they're incredibly comparable on most of those numbers. And if I was looking for things in the multi-billion-dollar category, I would probably, both of them would definitely be something I consider putting in it. I mean, if you had a value fund that was multi-billion dollars, I think both of these should be in it probably. Yeah. And I've always thought Stella-Jones would be a good thing for Berkshire, but it doesn't really work because Berkshire is in both utility and rail. But buying all of Stella-Jones would make sense. But yeah.
Got it. Cool. Well, I want to thank everybody so much for tuning in with the both of us on the Focused Compounding Podcast. If this is the first time you're joining us, hit the subscribe button. If you're interested in learning about our money management services, let's start the conversation by reaching out to me at andrew@focusedcompounding.com. Contrary to popular belief, good time to reach out is when stocks are down. Isn't that right, Geoff?
Yes. Yep.
It's a good time to reach out. If you're interested in Quick FS, you can sign up and tell them that you came from Focused Compounding during the checkout. I want to thank everybody so much for all the support, and we will see you in the next podcast.